Hello and welcome to Personable, a podcast focused on speaking to the world's best, enabling you to become the best that you can be. My name is Harvey Bracken-Smith, and today I'm honored to be joined by Yoshi Yokokawa. Yoshi is the co-founder and CEO of Alpaca, a leading brokerage infrastructure and self-clearing broker-dealer that powers over 7 million brokerage accounts across hundreds of fintechs and institutions in 40 plus countries. Alpaca's API provides access to stocks, ETFs, options, fixed income, and crypto, and has raised more than $170 million in funding to date. Yoshi started his career at Lehman Brothers securitization team, followed by day trading and co-founding a couple of machine learning companies before Alpaca. There's a lot to delve in today, from working at Lehman Brothers through the financial crisis, becoming a trader, and now building one of the biggest organizations of the future. So I wanted to get started, Yoshi, by asking you, what was your dream growing up?
I think my growing up is I always thought about what it means to be free. Looking at my parents, they are doctors. Of course, they work really hard. And then, they were not home. And then I had to study a lot for the entrance exams of the schools. So I was even always thinking about what it be like to make choices freely and what it means to be free.
And what was that? Why was trading the first rendition of that? When oftentimes people think of being free, I would think more like technology startup or something like that. Was there ever an urge to go straight into that instead of doing trading first?
I think when I thought about freedom, I always thought about limitation, restriction of money. I wonder, if you have a lot of money, would you be free? I never grew up with a rich family or rich environment, so I even didn't know how to be to be surrounded by money that you cannot even make a choice of spending. So I think that is the reason why I'm always fascinated about money and financial services. Probably that is one of the reasons why I didn't go initially into tech, but really looking into the financial services.
What was that like, not coming from a background of money to suddenly being exposed to hundreds of millions, if not billions, in large trading organizations?
Yeah, at that time, at the Lehman Brothers, the first thing I thought was that I wasn't even thinking about dealing with money. I was doing something that I was told to do. And then I was more doing the tasks and responsibilities that I was given instead of thinking about what it means about dealing with the millions, hundreds of millions of dollars.
And what was the culture like in Japan versus as a country versus in a globalized corporation like Lehman Brothers?
So I fortunately went study abroad in the United States for 3 years when I was in high school. So I think my mindset came probably a little bit different from purely growing up domestically for all my life. Funny enough, even though you're global organizations, when the clients are domestic, the organization has to be optimized to do the best in local basis. So our team, we were in fixed income division, which is capital market side. So most of the investors, most of our clients are extremely domestic financial institutions. So I think my experience was actually more domestic than working for the pure domestic organizations. That's what I felt at Lehman Brothers.
And, Lehman Brothers is obviously kind of one of the faces of what happened during the global financial crisis. You kind of get into that firm, you've worked there for a couple of years, and then suddenly there's this large market turmoil. What was the sort of feelings like during that process? Were you scared? You felt confident in your abilities? Could you talk me through a little bit about what you felt during that time?
I felt, firstly, I started my career in 2004 when I was in college, but I was working there full time. And then it was the time that things were getting better, more excitement, spreads are tightening, things are going up. And then people working harder, partying harder. So I think the continuing and maintaining that kind of mentality and lifestyle for a few years, you kind of start wondering, where does this go? Because if you're pushing harder, you're taking more and more and more, there's always an end to it. Even though I've never experienced a bubble, but I have been feeling, what does the end game look like? Because I think it will be an end because it's just not sustainable. So that was how I've been feeling generally. And then of course, I started seeing a lot of numbers start deteriorating, which is not really too visible to the broader audience of the whole economy. But I was looking at the numbers very, very closely. So I think I was kind of guessing or expecting that to crash. But the reality is that even though people know it's going to crash, nobody can really predict when it's going to be. And I think that's the reason why people have to keep dancing until the music ends.
I want to keep on this sort of path of going back through your younger life, and we're going to go back to this. But do you notice any similarities of the people keep on dancing and the numbers deteriorating to what's going on in 2025? Or do you think we're in a completely different market landscape?
I think the market, it's kind of hard to say the market does a whole thing, right? I think when I looked at back 2008, that was the numbers around asset-backed securities, subprime mortgages, and the synthetic version of that, like ABX and RMBX. Those numbers are specifically on the securitization mortgage market. And then that impacted balance sheet of the financial services institutions, that impacted the whole financial ecosystem, hence stock market went down. I think right now what we're seeing is probably very different. Obviously everyone, I don't think anyone kind of disagrees about bubble in AI or those things. But at the same time, we also don't know how big the impact will be as an industry. I think the reality is that when the innovation happens, and I think securitization, it's in a way financial engineering innovation. When innovation, those things happen, there is a end goal that will be, but it will never be a straight path into the result. So it's always left and right zigzag. And I think that's what we are seeing and what we have to expect what will happen. And in terms of the impact of that will happen, it's kind of hard. But again, of course, I do feel that we're dancing with the music. I don't know when it's going to stop. I wish I knew, but I'm not going to try to even guess it.
Yeah, on the podcast I was literally doing just before this, something that I found really interesting, I was talking about the difference between an experienced mindset and a youthful mindset, right? I mean, I'm only 21 years old, I've been in college, and so you could say an experienced mindset is someone that's, faced the global financial crisis, faced the 90s, faced the tech bubble and everything that was going on there. They'd be able to sort of notice the warning signs, but they kind of pin down to their own typical historical beliefs. So one of those being that gold is often used as a hedge to go against what's going on in equities and also as a hedge against fiat currencies. But at the same time, in recent years, you might say something like Bitcoin or other cryptocurrencies are also being used as a hedge. But something that I found as a more novel investor to be quite weird is it sort of seems that gold and silver, for example, are kind of being used as a hedge with no limit. It almost seems that if gold was to go up to 5, 6, 7,000, that people would, and the equity markets also did extremely well, that people would still say gold, is still a hedge. But for me, as a novel investor, I'd be I get the extent to which, obviously there's value in gold and, we went away from gold-backed currencies, etc. But there's got to be a limit, right? Maybe 1x or 2x the price of gold, or even Bitcoin. You could say it's a hedge against fiat currencies. But as you said, with the dancing against the music, there's got to be a limit. So that was kind of a question that I was facing in my own understanding of the markets is, to what extent are things a hedge, but how does that play out when the market goes up to such high levels?
I think there are a few things that we should be thinking about, talking about those hedge and whole, circulation of money. I think there's one thing that I really felt during the the 2008. At that time, a lot of people are talking about, of course, gold, but a lot of people are talking about diversification of the assets in the portfolio frontier. Especially I dealt with a lot of pension funds globally. What they think about is traditional assets against alternative assets. And at that time, alternative assets was, for example, commodities like gold, to the PE and venture capital hedge funds, because that should be uncorrelated to typical capital markets, which is equities and fixed income and those things. But the reality is, whole pie of the circulation amount of the money in the system, gets reduced significantly. Then of course, money into those illiquid assets that should not be correlated to each other will go down as well. So there is really not a hedge in that situation. And that's really experience that we had, and nobody was really talking about that until that happened. So I think even though there's a lot of experience and then a lot of theories that will be talked about, the reality is as Nicholas Taleb was talking about as the black swan, because nobody really understands until what happens. It's really not predictable, understandable. So I think that's a kind of first component that I feel that exists in terms of the hedging, because sometimes it's a hedging against some asset classes that you hold, instead of it's a hedging against the whole financial circulation of the money going down. There you have to be hedging every single component, right? So that's kind of really, really difficult. And second thing is that also there's a limitation of the how people remember that you can learn from. For example, Ray Dalio talks about short-term debt cycle of 8 to 10 years, and long-term debt cycle is 80 to 100 years. And I think that's very similar to any natural disaster that happens as well. we as a the person coming from Japan, we deal with a lot of earthquakes and tsunami. And if you see the period of the like disaster tsunami happens, it's around like every 80 to 100 years. And the thing is that like the people's lifespans around 80 to 100 years as well. Because like if people die, the only key thing as a human being is that you can communicate what you have learned in the past generations to the new generations. But I think the reality is that's extremely overrated. Because like if you try to understand what happened 200 years ago by reading books, like can you confirm that that books is really real or not? Like 200 years later, people look at what we've been communicating, consuming as information about the TikTok, Instagrams, and books. You don't know if it's a fake news or not. So I think like those generation of the knowledge transfer, in my opinion, extremely overrated. And that is the reason why we continue to see very same tendency of like long-term debt cycle. And then there's a certain thing that we just don't know, we can't know. So I think like embracing the fact and limitation, in my opinion, is the key to be a better, the figuring out how to live better with the less stress.
You pointed out something very important there, which I think the ordinary investor wouldn't understand, is that if you look at, say, bonds, gold, equities, credit, whatever it may be, real estate, many of them will have there'll be different correlations and different rates of growth on the up. But on the down, when markets go down, as in 2008, they're often very correlated in how they go down. So people often mistake correlation as the up is also going to have correlation or a lack of correlation on the way down. And I think that's something very important to note. I also think what you said about the news is really interesting in terms of being accurate with information. And kind of just to throw myself under the bus there on the podcast before, I was actually saying things like X and YouTube and social media is a good way to look at news and stuff, not simply because, and that's a good point you make about how accurate information is, but to an extent, the rise of the retail investor is getting much more important, as shown initially by GameStop a couple of years ago. But now there's lots of companies, even like the Goldman Sachs basket showing like meme stocks with like Palantir in it. I think it's got like Paramount in there as well. If you look at companies like that, they performed incredibly well, which is showing an increase in like the impact of retail investors. But the problem is that despite what all my economics professors at Duke want to tell me, the stock market, a lot of the information is actually driven on emotional responses. And so even to your point, if the news isn't actually accurate, a lot of this information is still driving people to make decisions which impact the stock market. So I think there's benefits in both, even if the information is wrong, knowing that hundreds of thousands of people on Wall Street bets on Reddit are trading off it, it can help inform your decisions. What do you think, because you've got amazing exposure to what's going on in the broader markets, what do you think, I'll ask this as the last question, then go back to your story, but what do you think is a good hedge in terms of for portfolios? So less so from more sophisticated investors or even people building off your platform. But let's just say the ordinary person, right, that wants to protect their money. What do you think is a good thing for people to do with their money with the threat of a potential financial crisis in the next few years?
I think when thinking about the hedge, is that a hedge against, because like each person has a different context, in my opinion. As you just said it by yourself, you are 21 years old and I'm over 40 years old. And then like each of us has a different type of the things that we want to hedge and the amount of the things that we want to hedge against. And then if you are, in Australia right now, you are, born in the UK, I was born in Japan, and there are a bunch of the people born in different countries like Indonesia or Turkey that has a completely different interest rate environment, and then political environment is completely different. So I think like when you think about hedging, we have to really specify what we're hedging against and what we think we want to be hedging. And the local context and personal context is, in my opinion, is the most important thing. So I don't think like we should be saying that this is a good hedge for you when it is a good hedge for me. And that's the whole purpose of like why we are building our company as an infrastructure. Because what I've learned is that relationship to the money or like protecting something is extremely culturalized and localized. How you think about it as an American or English or Japanese or Indonesian, we all have a different types of the mentality about money. So I don't think like, we can create like, the same setup. And that's the reason why we build infrastructure and we work with like local financial institutions and the entrepreneurs a lot because they know their context locally. And I think it's extremely hard to make it abstraction of like what's good for everyone as a human race.
Thank you. Thank you for that clarification. Could you take me on the journey from Lehman to, going to another bank, to becoming a day trader, to starting a software company, just very surface level into what led you to start Alpaca? And then we can go into more detail on the infrastructure.
Sure. So, like when we, obviously Lehman disappeared, and then Nomura acquired our department. So, I was there for like a year. And I think like at that point, like I was kind of getting tired of how I was doing everything, anything with a brand of what I belong to instead of who I am. And I started feeling like doing those like, capital markets, trading, syndication, and all those things. I started feeling like when this information A comes, you do action of B. Make these phone calls or like, get this information, hence you do these transactions. Like I started having this like logic equation formula in my head. And then at that time, I started like formulating those equations to be as optimized as possible. I started feeling like I'm extremely replaceable. And I even started thinking about like, the machine should be replacing what I do. And that's the kind of feeling that I started having. So like I was like, okay, I really have to kind of remove myself from the big organizations and what it be like to be by myself. And at that time, of course, I'm not a software developer or designer or anything. The only thing that I was able to do is, okay, let's try day trading because I'm exposed to the markets. So I should be able to do it. So that was a very shallow reason why I went into the day trading.
How did you go about actually doing day trading? Like, were you using leverage? Did you have like an amount of your saving you were putting to the side? Like, how did that actually go about? Because day trading, I feel like nowadays in 2025 gets quite a bad rep because I think a lot of people associate that with like course sellers or, look at me, I can make infinite amount of money. So could you talk a little bit about what it was like to do it properly at that time? You don't have to say exact figures of how much you were using, but just kind of give a bit more scope around it.
Sure. I think Harvey, like it's not that different compared to like when I was trying to do like 15 years ago. It's the same thing. Very bad rep. And then like, what are you talking about, right? and then I was doing basically leveraged FX trading, which is the most I guess like liquid market. I think it's still now like euro, dollar, yen. The reason why I picked that is because I wanted to see how it's like to be in the street fighting. Because it doesn't matter where you're from, who you are exactly the same. It doesn't matter you're from Goldman or Lehman or you're from like, street on somewhere. You have to deal with the exact same market environment as an individual. So that's what I felt, logically, like kind of emotionally, that was a very cool place to be and extremely harsh place to be. So like, when I started it, I really didn't think too deep. Like I just started doing it without thinking about bunch of the money management and made so many mistakes and then started doing okay. But the journey was ended up to be like if you don't have enough capital, it also becomes extremely difficult to actually support your living. And then the revenue that you make per hours, it's not that high unless you have huge capital. So that's also something that I've learned in a real experience. And at the time, like my friends was like also leaving the big tech companies and started doing this machine learning companies. And then I didn't have to be up like all hours looking at the FX market.
Yeah, I actually think this draws quite strong parallels to two separate podcasts I've done. One was with a guy by the name of Tommy Highland, and he's actually one of the greatest card counters of all time. He's in the 2002 Blackjack Hall of Fame. And if you've ever seen the film 21 on Netflix with the MIT group, he actually ran a team that was more successful than them. So he did extremely well for himself. He acts very humble about it. But I interviewed him again. I've interviewed him twice, but I interviewed him again last week. And what he's saying sounds like there's a strong parallel between that and day trading, in that in counting cards, when you're actually doing it right, it's about the number of hands you can do per hour, the size of your bets, and the edge is only like 1%. So when they're actually doing so many things, you've actually got to just do well consistently. And if it's the same thing for day trading, the size of money in your purse has a strong link to that. On top of that, what he was saying is like sometimes just because of the way the odds work, you could be wrong so many times in a row. So you need that ability to get more capital. And obviously you have that in a bank, but when you're out by yourself, that can be a lot harder. I found it very interesting, your point about street fighting. Is that something you've ever done in the real world?
I wouldn't want to answer that because like I'm get in trouble, but I don't know. No comment.
I feel like I'm getting the true inside scoop on the podcast. Who would have known? So you do that, you realize that not only is the amount of money that you have not good enough to be able to make obviously you can make consistent returns, but being your ambitious self, not having as much money around you growing up. You're very like a very ambitious person, and you realize that machine learning and algorithms can also do that day trading element while you're sleeping. So you don't actually just have to sit there. That same level of freedom you wanted from day trading, it's still getting kind of monotonous, small amounts of money, not outsized returns, etc. You then create a software company and then transition into Alpaca. But you mentioned before you didn't have like software abilities. So did you learn to code on the side? What was that journey like going from non-technical to technical?
So I'm still not a technical founder. Of course, I had to do some writing of the code to automate my trading strategy and then those things. But I'm not building a database or something. So I'm not a technical founder. And I think that's when I met with a bunch of my friends who are computer science background, working for big companies, like big companies, leaving the industry and starting something new. So I think I was fortunate enough to be a part of those conversations when my friends were trying to start something new.
What was that? How did you actually go about doing that? Because if I go to 2025, for example, there's kind of been different waves, right? There's been different waves of you need to be technical to start a business, or you need to be non-technical because you might be better at sales or stuff like that. But Y Combinator, so actually going boots on the ground, which you were a part of, Y Combinator often focuses on, particularly nowadays, having people, might even be both founders, have to be technical. So there's a strong focus, not just from the companies that are doing well, but also from where the VCs are signaling what they're looking for is looking for technical. Could you tell me a little bit about how you structured your business or your ideas, at least initially, to be able to convince a technical person to work with you, and whether you think there still is room in 2025 for non-technical founders to build great businesses, or if they just simply have to become technical to succeed?
So in my case, I started working with my best friends from college. So it's not I had to go start dating to figure out who's my partner technical co-founders are. So I think I was fortunate there then. And the second question about you have to be technical. I think being technical has a lot of meanings in my opinion. And then this is also about yes or no binary, right? It's technical meaning, okay, do you really write a code in a full-time professional capacity? Or you can understand how the things work and you can look through the code base and understand some things. It's two different things, but probably many things, for example, investors or venture capitalists that most likely not really technical, you can say that technical as well, right? So I think you can kind of fake it because as long as you understand the conversation and that you can explain how the things work in a way that they feel okay with, I think that's enough for me, in my opinion, when you are starting a company. Because I think it's more than being technical, in my opinion. What's important is product market fit. And then in order to run the company, product market fit isn't enough. I think there's also founders market fit. Because if the founders are not excited or passionate about the market, you can't continue. So product market fit is not enough, founders market fit. So, you may not have to be technical as long as you're fitted into the market that you're trying to solve.
I think another thing in the VC world, right, is that I have seen a ton of new AI companies popping up at the moment. And I'm not dissing this at all because I haven't done this myself, but I see taking it a step back. My dad is the CEO of his own finance company. He's a non-technical founder, and he's also building his own company on the side. And without naming specific numbers, I know that a lot of money has gone into hiring the right teams, building the product. He started building this in 2019. It's now 2025. So he's changed a lot of times. The product and team haven't worked out. And in terms of, he has his other business which funds the idea. So it's not like he has VC money that has a limited amount. But the runway in terms of how much money you need to truly make this big structure happen is a lot of money. And I see a lot of founders go and raise a couple $100,000 or $1 million or $2 or $3 million, and they present it to other people my age, and it makes it seem like this incredible thing, and it is. But if you're going to hire a software engineer for $100,000 or $200,000, the amount of growth that you need or reinvestment that you need is just not realistic enough. So you have raised $170 million. How have you thought about raising VC money? How have you thought about runway? And to what extent do you think VC money was necessary for the mission that you have gone about building?
Sure. I think that because many businesses actually have to create this J curve, and then J curve as you have to keep investing without making revenue. Hence, you can start scaling and then you can recoup in the money back that what you have invested. I think like, most of the businesses like that, like, you have to start firstly create the product, or you have to firstly create a community to start making revenue. And if you're have like other businesses or like other anything that's generating cash, then of course like that can fund those J-curve, bottom. But like, if you don't have that, you got to figure out how to fund that business. So like, funding can be your own cash flow, you can be your own saving, it can be someone else's money, it can be equity, it can be debt, like, however it takes. I think like, that is just necessary. And just simply like, in the world of the Silicon Valley, I think like access to the venture capital money, which is the equity capital, seems to be the more of the templated solution. And I think that's just like, simply how it works. And the reason why like, that venture ecosystem continues to scale is that because it seems to be that is the most fair, I'm not saying the best, but like probably the most fair way of taking the risk and taking the return by the people who gets involved in it. And then I think it's going to continue to evolve and improve. But I think like as of right now, that is probably the one of the best that exists right now to trying to get the funding.
If you were to start again with this business, would you build out the idea first and try and bootstrap it? Or would you get funding first? Because I see a lot of people pre-idea going into Y Combinator or other different regimes to go and raise money. Like, do you think it's better for people to actually go out, build a business? Because it's not just a point of what is best for the business, but you see a lot of companies these days or founders that get so diluted that even if they build a unicorn, they haven't actually earned much money back from it. And even maybe early employees as well, they might think, oh, our company's valued at 100 million, but in terms of how their stake has been diluted over time, what they have is worth significantly less. So could you answer that question of whether you think that for most startups, it's best to go and get VC money first, or if it's better to build a little bit firsthand, and if you would do the same thing in 2025?
So I think like, answering like, two ways, right? So like, first way is that like in generality of like, that is it better to bootstrap it or those things. I think it depends, in my opinion. For example, like in our case, the business that we built, we had to get the broker-dealer licenses. We had to get, hire a bunch of people without making money, because that's a requirement to even start a business. So in order to bootstrap it, I had to create some consulting business or some other business that I have to co-found and then use that some kind of EBITDA positive into this business. But if I start doing that, building startup is not that easy thing. Not having my 120% paying attention to the product market fit configuration will not going to succeed. I'm not a Superman, and then I can't do 120% in both things to figure it out. So I had to pick one way or another. And I think it's going to be the same even if I were to start the same thing right now. Because like, the mental capacity of spending time 120% actually creates this miracle that you can figure it out. But if you don't, you just won't get there if you are not fully committed to it. And I think that is a kind of reality that we have to face. So that's the reason why you still, I think I still have to go to get the capital, how to focus on the one thing that I really have to solve. So I think like, that is the first answer. And the second answer about the dilution, I think in my opinion, like it's a dilution also comes with, are you targeting $100 million market cap company, or are you targeting $100 billion market cap company? And then like, targeting that amount of the market valuation connects to what is the total addressable market and the market size and what industry that you are going after. So I think like, as long as that is viable, what is the end state? Of course, like there's IRR perspective, like how many years it takes. But like, as long as you know that it's going to be not 100 million company, but $100 billion company, I don't think dilution conversation becomes less relevant, because you start focusing on achieving your mission vision to max the value out of like what you're trying to do.
I think that's a really interesting way of putting it, and I've never actually thought about it that way in terms of purely just, if in terms of it's a billion, right, maybe I get screwed over. But if the actual mission is 100 billion, I need these investors in order to get there. Like I was even looking at OpenAI earlier today, right, in which they keep getting more and more money. And I know they're technically still a non-profit, but they're still raising so much money, and for something that's going to change the world. I mean, we were looking at earlier in the markets podcast, like the South Korean stock market's up like 60% in the past year. German stock market's up like 22%. The UK is up like 18% all in the past year. The US is also up like 15%. You look at all of these, and a lot of this is due to AI. So if that's all pinning back to NVIDIA and OpenAI as the main sort of companies that are sort of doing this, it makes sense that Sam Altman would be willing to dilute. I think he claims he doesn't have any equity, but I'm not really sure what's going on there.
That they're trying to change by the converting the NPO to the commercial, right?
Yeah, exactly. But it goes to your point, right? That if the
Yeah.
market is not 1 billion, 100 billion, but it's like a trillion or 10 trillion or 100, whatever it is, that makes a lot more sense. I mean, you even see Elon Musk with his pay package of Tesla, in which he'll get given a trillion of Tesla shares if Tesla gets to 8.5
Right.
trillion in market cap. So all
Exactly.
these milestones make sense. So I know I'm still going in a lot of detail on VC, and we will get to the main crux of what Alpaca is. But I've been much more involved in this sort of area of VC. And I transitioned my podcast recently from purely just focusing on speaking to the world's best to sort of like, I was like, how can I segment these people into categories, right? So I've kind of got public markets. So I'm interning at Goldman Sachs in sales and trading next summer. So that's kind of like part of my interest. The next one being more like yourself. So sort of like founders and VCs, like private markets. And the last one just being general high performers, like famous and talented golfers, actors, etc. But on the VC standpoint in particular, that is something which I found really interesting because if you point to someone like Harry Stebbings in the UK, for example, who has the 20 VC podcast, I was actually writing a LinkedIn post about him yesterday. What's incredible about what he does is he both has access to the incredible people and the capital. And obviously through this podcast, I've started to get access to incredible VC people and entrepreneurs. And some people gave me the idea of actually going and starting my own VC fund. And I'm not sure, maybe I'll do this in the future, but for right now, it's not something that I want to pursue today. But I started to speak to both VCs and founders. And I initially thought as a young kid, like, you know, who would back a young kid, right? But the more people I spoke to, the more good ideas I had. But interestingly, the more momentum I had, the more that people were interested in backing me and doing this idea, etc. And the answer to why I'm not doing it is it's just not the right timing for me. But I want to ask you that same question. I want to ask you three questions off the back of that as someone that's gone and raised $170 million from VCs. How do you go about proving to VCs that one, you're the right person to go and build this? Two, how do you go about convincing VCs to back you? Is it more about what you say, what you have? Like, what do you think is the biggest convincer to get VCs to put their money where their mouth is? And lastly, what is the right time to start? You've obviously had experience working at Lehman Brothers, working at Nomura, and also being a day trader and building another business. So you've worked at like 4 or 5 different companies before you built this. Do you think it's better to get experience first, or if you have an idea, go for it? So it was linking to the idea of how do you prove you're the right person? How do you convince VCs to back you? And when is the right time to start a business?
I think in terms of the convincing, starting from the second question, is like, convincing, it's really hard. Like, you just like, that just throw so many balls and maybe like only a couple or few actually, goes through, right? So I don't know if there's a right kind of analogy or methodology. It just, I feel like, you have to treat it like cold callings or cold emailing. Think about it more emotionlessly, like a machine. There's a sales funnel of how many of the prospects, and then second funnel, the conversion rate is 20% or something, and then you just filter it down, and you just kind of track that as a data as a machine. Otherwise, like, you become emotional, and like your mental is not sustainable going through that pain of like, getting rejections so much about the work that you have been putting so much energy into. So I think like, that is hopefully the answer to the second question that you said. Just take it emotionlessly, objectively as a machine, and treat it as a data. And then like first question about like, how do you convince like you are the right person? I think that there's a phase of the company where we could tie our product or business into company. Because like, when we are starting a company, we shouldn't even spending time on like mission, vision, or whatever. The only thing that we need to be focusing on is how we get to the product market fit. That is the only thing that matters. And then in that case, it doesn't matter if you are the right person or not. We just need to get the product market fit right. That's it. And then when it starts working, then like, we start thinking about like, if that connects to me as an individual to run the company. Because like, running a product and running a company is a little bit different, because running a company means that you need to continue to have the right people in. And then at the time, like, you start kind of adjusting yourself about what is your why you are involved in this product anyway to begin with. How can you create a story that's convince your brain that this is something that you started to thinking about at the very, very day one, even though that wasn't the fact. So I think like, the firstly product market fit, but like, kind of convincing yourself even, this is a story that we're going to keep telling. So it becomes really the story. And I think that is the how you say that you are the right person. because you need to say to yourself that you're the right person, and you need to create the story and logics behind that. So that is an answer to the second question. And in terms of the third question, which is about the timing, I wish I knew, because like, at that time when we started Alpaca, I even didn't know about how the startup works or how the venture capital works. I even didn't know that startups have to have a product. So like, that's how much I didn't know anything at all about doing a company or doing a company tech startup in the Bay Area. So that's how much I didn't know, and I think it's doable. So like, I think timing can be any time, right? Like, if you have some idea, in my opinion, like if you're feeling it, like it's now. Because like, what I realized is that, especially YC, like I met with a lot of like, my batchmates that they're super young, but like they've done the businesses, like few businesses already, because they may have started in like 13 years old. It's same thing as like if you start preparing for like SAT tests, like when you were 9 years old, instead of like preparing for the SAT like from 16 years old, you have the much better results when you're 18. So I think like doing something earlier, in my opinion, is always better, because you don't have to succeed at that time. Like doing that and having the experience actually creates much better outcome later on.
I think it's really interesting, and it's definitely, so I want to take you back just to my own personal like mindset and stuff. So I mentioned to you before the start of the podcast that I'm from a little island called Jersey near France, and my parents have done very well for themselves just anyway, but they didn't go to schools like Eton or like Duke, where I'm truly surrounded by some of the most academic, smartest, hardest working, determined people on the planet that will go into top jobs, right? And so when I first went to Eton, there was definitely a lot of like imposter syndrome for myself, right? Because I went from being on a little island to suddenly going into this place where these people were smarter than me, harder working than me, not in terms of like IQ, but in terms of like, they had experience working with and competing with the best in the world. So I went to bottom sets, I went to lower sports teams, etc. But I found something called the Society Program. So from 8:45 to 10 p.m, Monday through Friday, I hear from past prime ministers and presidents, CEOs and founders, doctors, etc. Right? So that's kind of what started off the idea of this podcast a few years ago. But something really interesting there was I found that there were all these successful people, didn't all go to the same schools, didn't all go to the same universities, but were all of different races, genders, backgrounds, etc. And so that kind of gave me the confidence to listen and hear like, oh, maybe I can become really successful too. The reason I mentioned that journey is those three questions of the right person, how to get a VC to back you, and when's the right time to start. Even now, I expected you to answer with some complicated, I won a math Olympiad when I was 5. There's this secret toolbook to becoming a VC or whatever it is. And of course, there's an extent to which you're really intelligent and hardworking, and you've still gone to some of the best banks on the planet. So for anyone listening, you've still got to upskill yourself. But I think there's a liberation to the fact that it truly comes down to how many cold calls you do, how convinced you are of your own story, and how well you can tell that to other people. Because at the end of the day, no one has a 100% certainty of the future. We all kind of have this vision of what this thing could be, but with the right resources, with the right people working with you, with the right story you tell yourself and the people around you, that's what gives you the higher probability of getting there. And so another LinkedIn post I wrote yesterday was about giving myself the best chances of success. But I feel like if you truly want to achieve super normal levels of success, there is always a degree of uncertainty, not knowing what's going to go on, and also a chance that you might fail. And I think that's a really interesting thing to understand at any age that you may be.
Right. No, I think you summarized it the best. It's like, I wish I had that kind of fancy story, like, all other founders are talking about. I don't.
So you obviously have achieved success even from a VC standpoint. Oftentimes people will say you're really successful even before achieving what you would define as success, just purely from the amount of money that you've raised in venture capital. But could you take me from how you actually came up with the idea for Alpaca? And you also touched on before that you have this idea of what something is today and where you want it to be. So whether you're a founder and is it a $100 million company or a $100 billion company? So could you talk about what the idea is for Alpaca when you started it and what the vision is for Alpaca of where you want to take it?
When we started Alpaca with Hitoshi, who is my co-founder, we're just thinking about doing something in the fintech, because I come from financial services, and Hitoshi come from extremely deep tech, database, big data background. So like combining that should have some good results. That is like kind of general idea, right? And then we saw Robinhood at that time. That was like really the hottest company, and I really loved the product, and I really loved how they executed. So definitely like followed around a lot, like how we can be the next version of or something like that. And then like doing a lot of work around it, doing a lot of product market fit, user feedback, user interviews. We just ended up to be, we felt that we can't, create the better version of the Robinhood. That itself, we won't be able to do. But maybe this process of creating that kind of trading application and even thinking about what comes after mobile first, maybe it's really more of the agents and API first. So that was really the rough idea that we had, and we decided to take a bet on it. And that's the reason why we said, okay, we built the API version of Robinhood, and that's it as an idea. So we call it stock trading API. And that's why we went to YC for. And then it just became the API to be used not only for the buy and selling securities of the the trading purpose, but also people started asking me about, can I use this API to build my version of the Robinhood in my country or in my segment, in my geo? So then I realized, okay, this API can be not only for the API as an interface, but it can be actually the infrastructure. So there's a constant learning. We just create output and we get some feedback. It's not only about the feedback of the product, but feedback of how this can be as a potential, and kind of embracing that, figuring out how to execute it is our job. But as we keep on doing that, we start understanding the potential and the size of this massive business opportunity. And then that's the story that I have to keep telling myself that we had this vision from the day one, so that we can talk about it like an adult person to the VCs, so that they feel convinced, right?
I know this sounds like a very basic question to ask, but for those that are listening, could you explain what an API is in simple terms? And could you also tell me how you, if someone doesn't know about this, why couldn't someone else just build another API that is also the exact same as yours? So both what an API is and how you differentiate yourself.
Yeah. So API in my head is that interface for programs. So for example, humans has evolved from the communication face to face, and then it became through the phones when the phones invented, and because of this web browser it became the computer based, and then mobile first came, and then it became mobile first FaceTime or whatever. And then each of the time there's interface to certain actions or certain components of what the humans do. And what we thought about is that the next thing that will come would be the programs that replicate the human's actions or intentions to interact with other things, which means the interface can't be a mobile app, or it cannot be a web browser. It has to be some interface that programs feel the best about. And that we think about the API, because it's application layer, interface for the applications. So that's basically the API is. So it has no visual design, right? Because visual design is for human eyes, but programs don't care about how it looks like. It cares about how it's structured when there's inputs or there's outputs. So that logic is what creates the better API or developer experience. And the reason why that nobody can really do this, what we have done specifically on this API, is that we're API in this broker dealer or securities industry. And firstly, it comes with so many licenses and approvals to just touch people's money, people's securities, and then making sure that the fraudulent activities don't happen. There are so many licenses modes that we had to go through. So that's the one thing. And the second thing is that in order to actually create the real API, we had to think from the flexibility perspective, because when the programs or developers trying to figure out how to create some applications, the ultimate flexibility matters. You can't give that this is how it works. This API is used for only use case A. It has to be usable for any use cases that they come up with, and that is really different methodology as you create the financial services organization, building compliance and then operations. So I think we just happen to have the amazing combination of Hitoshi coming from big data, deep learning, and he's also very deep in the open source community, which is full of developers, combining with me coming from financial services. But we created our company as the tech company first, so that allowed us to create the real API instead of financial services opening up the API.
You mentioned both the importance of being accessible for code, obviously not for human eyes, but also about your licenses, protecting data, etc. That's oftentimes why big banks are pretty hesitant about innovation is because they've got so much money, and so the rate at which they're able to change is a lot slower, as well as regulation, but also because they've got so much money. How do you go about improving your business while also protecting the information and also implementing new ideas whilst stopping errors from occurring, which may leave open abilities for bugs or for fraudulent activity? Like, how do you innovate while protecting information and innovate while minimizing errors?
So there are a few things. So the first thing is that we are as compliant and as we're restricted, and then the report required by the regulators, that we are governed by any big financial institutions over our peers, like even Goldman, like exact same standard, like in terms of security wise, reporting wise, it's all the same. So we're 100% compliant on that. The second thing is that being big and then incumbent financial institution doesn't mean that you're doing the right thing, or doesn't mean that you're safer to work with them, because that experience literally comes from my experience going through Lehman Brothers. That was one of the biggest financial institutions with the biggest credibility. They went down. So size really doesn't matter. What matters is that the people who's running it, and then operations that you are controlling. So those culture values, all those things matter as an organization, just like any other financial institute, any other organization in the world, regardless of the size. When you're bad, you're bad, and regardless of the size, when you're good, you're good. So that's how I think about it in terms of the sizing question. And this is not something that people agree or necessarily loves to hear, but because of my personal experience going through that, I know. But that's something that I have to keep preaching about. And the third thing is that there's a different macro factor. So last 20 years, because of the cost of starting a new company and new financial services definitely went down. Because of course AWS and then a lot of ecosystem out of the venture, money put into the new financial institutions. So that's winning in a lot of countries. Like if it's in the US, it's Robinhood. Like if it's in the UK, it's Revolut. Those companies are actually now threatening, in the real threat to the traditional banking organization or financial institution. So if they don't react to update what they have as a system or infrastructure, they're going to lose and they're not going to be relevant anymore. So there's a big threat in terms of the timing that they have to rethink about it urgently. So I think those are the factors that we also see in the today's environment.
In terms of, you mentioned the banks, Robinhood and Revolut. I think those are a really interesting point. I actually use Revolut, and I've been really interested in the ideas of eToro, Robinhood, trading 2-on-2 with these sort of low cost fees, which are obviously being backed, like Robinhood's backed by Citadel Securities, for example, which is able to get no cost fees. How do you fit in that interface in terms of how do you show yourself? I mean, you obviously mentioned regulatory approval as a means to show this is why I'm the obvious use case. But how have you gone about getting partnered with bigger organizations? How have you gone about getting users? And also now that you've got to the scale that you're at, how do you go about getting new users? Is it just an infinite snowball effect that keeps on growing? Could you talk a little bit about that?
So first thing, I want to just, for the honor of the Robinhood, the whole industry, I want to correct what you just said. Firstly, Robinhood is not backed by Citadel Securities. Citadel Securities is one of the market makers that they offer the execution services to the Robinhood Securities. And this structure, it's called wholesale market maker system for the US equities and US options. Like all other big firms do the exact same thing. So just to be clear, they have been doing the exact same thing. They're getting rebates from the back end. They were charging fees to the end customers. So that's the reason why their TDMA trade charge up, their market cap went down for 30% when they announced those commission free, right? Because they still make money, but they were actually making more money. So it's not just the Robinhood or anything, right? So just wanted to make sure that everyone here heard it. Okay. And then in terms of winning the those big institutions and new clients, definitely we work a lot with the fast moving digital first companies globally, because that allow us to grow and then have the more use cases in many different countries. And then as incumbent financial institutions, it takes time to make a decision, and that's a nature. They have to do that right process and then governance perspective. But the urgency gets higher as we support more fast moving companies, because they're continue to win the wallet share of each of the regions and each countries. So I think that's how I try to make sure that we continue to partner with as many partners as possible. And that's the reason why we partners close to 300 financial institutions in the last like 4 years.
And how do you think about pricing?
Pricing in terms of like, how we price it exactly, or
Yeah, how you think about pricing, because you would have come into this industry with sort of like a theory of how this thing would have worked.
right.
But because you're focusing on, people building big applications rather than, something like Revolut, right? They've got so many users, they can use like a subscription model for the cards, take a percent fee on transactions,
Got
etc.
it.
But for you, like, coming into something which you kind of had a little bit of experience in, but then suddenly
Right.
you're building this multi-billion-dollar business.
Yeah.
How do you go about pricing?
So generally, like, how these financial institutions work is that what we see as an end customers, there's of course a front end experience, right? And there's often case those companies are connected to someone else for certain things. For example, Revolut don't have everything by themselves. Like they connect to, someone else for some markets or asset classes or some business lines. And that's typical. Same thing as Goldman Sachs. Like, they do certain things by themselves and they work with some other financial institutions accessing, I don't know, like Asian stocks or like whatever. Like it's all kind of connected. Like what you see is not 100% what's working in the behind the scene. So our business model is stay always in the behind the scene. So this like, the how this market works, and this for us it's more the securities clearing broker dealer industry. This has existed for hundreds of the years, including like Bank of New York Pershing to State Street and all those institutions. So there is already kind of established way of make money and make pricing. How we think about it though is that in order to offer the same services, how we can cut down our cost, like automation, building everything internally, making it scalable, definitely like lowers our fees like significantly, 1% of like what it is. So like, we can think about profit margin as a company and then utilize our super thin COGS. Then like, we can come up with extremely, in my opinion, fair pricing, because that's how it should be. Our partner needs to be making money. We should be making money, but like, we should be removing something that's not needed by internalizing our technology and removing certain middlemen. So that's how we think about it, about the pricing.
I've got quite a few topics that I just want to be able to touch on, but I'm conscious that we have less time in the podcast. So I'm going to call these short answer questions.
Yeah.
I know they're like bigger topics, but just try and say them in the quickest way possible.
Yeah.
The first one being, who do you look at as your biggest competitors? And what do you think will enable you to beat them in the long run?
So interactive brokers, and then how we beat them is just updating our tech stack and then internalizing all the technology that they do and they may not.
How have you found, because now you've raised $170 million, despite that, as you mentioned before, you're building a $100 billion business, that your stake will still be worth a lot. How have you found dealing with different investors and other partners whilst also maintaining your own vision?
I think like welcoming our capital partners, which is our investors, like I want them to understand what we are going first, and then they're okay with like how big we are envisioning, and then also like our mission visions are. So far, we are fortunate to have amazing investors supporting us and our big visions, understanding the size of the market as well.
Was there ever a time in which you had to ask for other people's opinions on investors? Like, how have you been able to raise so much money whilst also having good investors? I know on a podcast, you probably wouldn't be able to tell me otherwise, but I feel like that can be a problem with businesses when they get hostile investors who want to kick you out or want to like have a completely different mission plan for the business, or maybe like they're not doing as well as a fund and so they want you to IPO or raise new money quicker. Like, how do you deal with that? Or how would you advise other people to deal with that if you've done a good job of it?
So raising money is actually a two-way process. So like, of course, we introduce what we do like emotionlessly, mechanically, but like when investors wants to invest, they pitch us a lot and ask, give us the reference checks that, we do. And then, of course, like regardless of that, like I do reference checks for every single investors that, we welcomed. So that has been very fair process when raising money.
So in terms of AI, that's obviously been a big buzzword of the last couple of years. How do you think about integrating AI in your business? Do you think it can replace any part of your business? Are you worried about it? Are you excited about it? How does that come into your thinking?
I think like, I think all of us use AI in a very practical way, including like GPT and then summarizing and like, posting. I'm sure like your LinkedIn post, like primary written by the AI and getting updated. I think like everyone's doing that in multiple ways in the work operation. So I think like, that should continue to improve our efficiency for sure. But at the same time, like those others were doing the same thing, which means that we have to do more. So it may not really create much of the impact, honestly. That's the one thing. The second thing is that, we are a very heavily regulated industry. So like, it's not like it can be replaced by AI doing certain things. We actually have to do humans doing something. That's a requirement. Some of the things are very much requirement. There are certain things that just, don't get resolved by AI. But like, I think in my opinion, I just think about it practically what can be used, regardless of AI or machine learning or deep learning or whatever it's called. If we can optimize what we can do, and if we can increase our revenue, I'll take it whatever it takes.
Just to clarify, I actually do write my own LinkedIn posts, but AI, I'm sure, will become more in the future. On Japan specifically, I had 3 questions on that. How do you think about the culture of Japan with regard to entrepreneurship versus Silicon Valley? What can US tech learn from Japan? And also, how do you approach the line between innovation and tradition towards building in Japan?
US, Silicon Valley is the global center of the innovation and tech, right? But like, I don't think like Japan startup ecosystem should be like even compared, in my opinion. It's not really fair to be compared to the Silicon Valley. So that's my like kind of first reaction. And that reality, like, Japan startup ecosystem, they focus on Japan market. Like if they're not trying to go, they rarely think about going global from Japan. And I don't think they have to, because like if they want to, they should do that in the Silicon Valley. And that's what I did personally, right? Like, because this business only works if we're doing this from the the US and Silicon Valley going YC. So that's how I think about it. And then how the US can learn from the Japanese ecosystem. I don't know, like, Japan and like any countries, in my opinion, has their own unique histories, and then their economic downturn and upturn. We've had, after World War II, like, there are a lot of entrepreneurs came because like there's no domestic demands. So they had to be entrepreneur because there's no organization. They all got destroyed. So they have to do their stuff and they have to look for the demand outside. So that's kind of historical context. And I think like each of the country has that kind of historical context. Japan tends to have the very, I guess, like detail-oriented engineering mechanism, like, train not getting delayed for only a couple minutes, and like people start saying sorry that like when the train's delayed for 2 minutes. I think that's a very unique thing. Like, US can look at it, but not sure if it's good either. Like, it may be good when you're trying to get the better reputation, but trying to figure out product market fit, thinking about that detail, it doesn't help. Like, it just depends, I guess. But it's, Japan has amazing food and then amazing hospitality. Definitely, like, I want the US to learn from that.
How do you go about making finance more accessible to more people?
So our company mission is open financial services access to everyone on the planet. And this really came from my personal experience growing up between the US and Japan, is that if you're in the US, you have so many types of the financial services accessibilities, apps, products. And then once you're back in Japan, because you don't have an address in the United States, you even can't sign up for the Robinhood, or you even don't have accessibility to certain, like, cool products that's tied to the US credit cards. And that has been always frustrating to me. And that is really the reason why motivates me so hard about trying to achieve this company mission. It has to be fair. And then if the Japanese person, Japan and US is a very close country in terms of the policies and everything. But like, I still feel that way from Japan, which means that most of the 195 countries, they feel even worse. So I think our job is how we make it fair so that it's not only like Americans or like certain countries, people having the very, very good financial services access, but like every single person on the planet should be having the fair access. And also another realization that we had is that I just can't believe one experience can be optimized for every single person. As I said it, like, each country has a different language, different relationship to the money. So like building the infrastructure, in my opinion, is the best way for us to contribute to achieve this mission. Doing this Alpaca itself, achieving this mission, is to basically like, achieve how we can provide the better access to the financial services to everyone.
What do you look for in the people that you hire?
So we have those, it sounds like, corporate answers, but we do have 3 values. So our value is like, be accountable, stay curious, have empathy. So I think about those things. But like, genuinely, I want us to work with the good people. I don't want to work with the jerks. I want to work with the people who said who will do it, right? It's just very simple things. That's what I look for.
I think it's funny, your approach to values. I've never seen a co-founder or someone so high up taking the mick of their own values. I always get it. My friends, we might make fun of values, but not our own values. But I think at the end of the day, like jokes aside, what it boils down to in terms of saying you're going to do something and sticking to it. I think even through my own finance recruiting process, when I give advice to people in the year below me now doing it, I'm like, there's one piece of advice I can give you. It's just be honest and don't never lie. And what that means,
exactly.
It's not simply just don't like, what's 2 + 2? It's 5. Not just that, but it's like if you give your opinion on, what's the Fed going to do at the next meeting, and you say it's going to cut, and you don't have a 100% certainty that that's going to happen, you're lying. Like you have to always give those details, and I think that's something that people often don't really realize.
Definitely, I completely agree on that. Like just being honest. Like if you cannot make it or if you couldn't do it, that's okay. Just embrace it that you couldn't do it. Right? It's very simple.
It's very simple but very powerful, and I think it's like it's what differentiates those that succeed a lot versus those that people don't trust. What's your approach towards using leverage in your own investing? I saw another interview you go about dollar cost averaging for your own investing, but then you go about using like 50x leverage for crypto. Like how do you approach using leverage in your own investing?
In my own investing, I don't usually I don't really utilize the leverage because I think investing is just like keep adding exposure to the market. I think like when I use leverage, that's for the trading and speculation because that's a very different purpose in my opinion. Or like I was forced into it. Like basically crypto leverage is basically I was forced into it, and that was like more speculation. Like other than that, like I've been buying the same amount for I don't know 5 or 6 years, the same Bitcoin either. So in addition to those speculations, so like I consider those two things as two different things.
What is the question that you're not often asked enough?
About like or
about your life, about your business. Like a lot of what I've asked you about Japan, entrepreneurship, YC are probably quite common questions. Like what's a question you're not often asked enough that you would like to talk more about?
I think those negative things are not really asked enough maybe. The people asking about burnout, people asking about giving up, people asking about quitting.
So what have you learned about burnout, giving up, and quitting?
Well, I think in terms of the burnout, that I had to think about the founder market fit. Because the how you live or how you feel naturally has to be fitted into what you do as work. And fortunately, or unfortunately, startup or doing this business, running it is a part of your life. There is no work or life. It's one thing. So it has to be aligned mentally, emotionally, naturally. Otherwise, you will be burned out. And I think in order to avoid the burnout felt as of today, I think that is the only way to solve it. So that's about the burnout, and that connects to giving up and quitting, because that connects to giving up. If you're burned out, you don't have energy, so you're gonna quit, and then you're gonna give up. So it just really comes back to what you naturally are. Your natural anger, natural frustration, natural motivation, natural happiness. Is it connected, aligned to what we do as a business? And I think that's really important to me.
But could I ask how you navigate that? Because I would also say, right, like on a smaller scale with this podcast and what I do, right? This podcast actually ties in, as I mentioned before, with the societies and stuff when I was younger. It ties in quite a lot to my own personal goals. But even though many people might just be like, oh, it's just a podcast, like it genuinely aligns with a lot of my North Star in terms of meeting amazing people. I even mentioned potentially launching a VC off the back of this and lots of other ideas that I had. So this kind of aligns with my North Star. But both at the one time, I really want to push it, and I want to go about achieving these goals. Like I launched a website a couple of days ago. I'm starting to get great guests like yourself. I'm looking at doing in-person podcasts. I'm starting to look at getting sponsors and stuff like that, and really trying to build it out and optimize in every way I can. But at the same time, there's the social pressures of family and friends and my girlfriend. And then on top of that, there's also schoolwork. And then aside from that, there's also pushing so much, but sleeping well and exercising and stuff like that. So I think you can still have it as your North Star, but there's also the other responsibilities. And you might even want to push as hard as you can with this, but by pushing too much, you burn yourself out. So even if it becomes a part of your lifestyle, how do you make sure you sometimes hold back a little bit to keep your other relationships, to keep mentally and physically fit, and also to stop it from taking over your whole life so that you do have longevity in what you do?
I think that's a constant learning, in my opinion. That unless we push the limit, we won't know where the limit is. Because like if I start thinking about those, what is that like, kind of getting scared about things getting taken over for my whole life, unless we push it, we don't know when the ceiling would be. I think like, I'm sure like you do like, a lot of like sports, like, you push your limit into where it's going to break. Like, you could get injured, but that's the only when where's the limit. Unless we try, we don't know. So I think that's how I think about it.
Yeah, so more about like find your limits and then be obviously try and push past those, but also be cognizant of it. But you only get
Exactly.
that by experiencing it.
Exactly. Otherwise, like, no one else other than who you are will not be able to tell you this is your limit. That's how I feel, because like when it's really, really bad, like you feel it yourself. Like I feel it myself, like, oh shoot, like I'm really traveling too hard. I'm really not sleeping much. Like, my mental state is just not good. I feel it because like, I got into the space and I'm getting to the danger zone. Like I will cut down myself, right? Otherwise, like, it's so hard to do that by anyone else monitoring, in my opinion. Like, I think there's a therapist and then the coach and everything, but at the end of the day, you're the one who make decisions, in my opinion.
Yeah, I think burnout as well is something that's very dangerous. Like I got properly burnt out after I finished school. My mum unfortunately was unwell, and I could just push myself too much.
Right.
And even like while I like lowered, let's say if my normal output was at like a base level of 100,
Yeah.
I even went going down to a 50 after I'd been burnt out. It was too much, so
Right.
it kind of prolonged it. So it was obviously sadder, harder to exercise, harder to think. So it's actually like now when I'm approaching those points, I'm very much like not traveling. I'm gonna
Right.
slow my work, take
Exactly.
breaks. It's really important.
Yep.
It's a proper thing. My three final questions. The first one being, if I was to ask someone in 100 years' time, how would you want to be described, and what would you want your legacy to be?
I don't have anything like that. Like, I just want my kids to live healthy and then my friends to continue to live on. Like, I don't have any expectation or like any desire to be remembered or anything. As long as my kids and my grandkids and my grandkids remember who I am, that would be the best.
And what do you want to be remembered as? Like, you say you don't want to be remembered, but evil, kind, motivated,
No.
hardworking.
I think like I really don't care, because like when I think about my ancestors, like, family tree, I don't even know, I don't even care like if they're a good or a bad person. Like, they are part of who I am, contributed my existence. So I truly appreciate that. That is the only thing that I would look for.
You can look at any scope of time you like, 3 months, 3 years, 30 years, 300 years. What's next for you?
What's next for me? I don't know. Like, I think like, next 3 to 5 years, probably, like, I think about it. It's so hard to think about 30 years, but like 35 years, I think about it in terms of life, the business. So probably that is a period that I think about most.
And the final question, and I ask this to every guest on Personable, is what is one thing that you would want a listener to take away from this episode?
I mean, there are multiple paths, and then there's multiple journeys. There's a template, but I think like, we can be who we are. And I think like, as long as we know what we are, what we can be happy, how we can be frustrated about, I think that can be connected to what we do every day. Like, that as long as that delta gets minimized, I think like, we become who we are as many hours as possible. And I think that's the experience that I've been going through every single day.
Well, thank you very much for coming on the podcast today, Yoshi. I feel like I've learned a tremendous amount from your background at Lehman Brothers and Nomura to your day trading and how that, I've been looking for a course coming out soon on day trading to go building Alpaca, and even just your realism in if you want to go and raise money, be emotionless, focus on when you're finding an investor, it's just as much about if you like them as if they like you. Actually having your North Star is not simply just some arbitrary route, but actually a specific amount of money in market cap so that you can protect yourself as a founder to say, if I want to get to this point, this is how much I can dilute myself. So this is how much I can raise in order to get to that North Star, not only quicker, but more efficiently by raising the right people to stop the competition from trying to get me. I really appreciate your insights on a wide variety of topics. I've learned a lot. I'd love to stay in touch moving forward, and the listeners learned a lot as well.
Appreciate that. Thank you very much for your time, Harvey. It was fun.